budget from salaried individuals' point of view. So basically,
hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Vinit Bolinjkar of Ventura Securities, Kalra of Target Investing, and Foram Parekh of Indiabulls Ventures join me on the show. Today on the show, we'll discuss Divi's lab. The traction certainly seems to be there, whether the traction will continue. We talk about the two-wheeler space, whether the traction will continue, whether it's worth buying in as far as any of the two-wheeler stock is concerned. Nifty basically is moving on only on a back of a couple of stocks, Reliance, TCS, Axis Bank, Infosys. So we ask our guests what's the pecking order on the Nifty at this point of time among these three stocks, and one stock that should be accumulated for a positional trade. Let's start with the first stock, and the first stock that we want to talk about is Divi's lab. Now, Divi's lab did manage to rally significantly. If you're looking at the numbers, extremely strong stock trading at record highs, has managed, and it was trading at less than almost 400 when the entire issue of the import alert came in. They've come out of it, and again margins are now back about the 35% mark. Will the rally continue, or is it too much for Divi's lab now? That's something that we'll ask our guests. So Vinit, I'll start with you. Divi's lab, it's rallying. It's one of the best performing pharma stocks, at least in the last few quarters. Will the rally continue? Are now valuations now getting expensive for it, or will the issues like the China API concerns and all ensure that the rally will continue?
So I think the rally will continue, but it will continue at a slower pace.
Okay.
Valuations are very expensive. It's at 30 times. ROE is about 20%. And they do have 2,000 crores of cash on hand. But the important thing is that, they have not been able to ramp up their capex very quickly. It's delayed. And, ramp up is also slow. So we will see a little bit of measured growth in the year FY20, and 21 is when the numbers will start coming in.
Okay.
So I think they'll do about 300 crores of debottlenecking. 500 crores could come because their capacity is at 86. Given the situation that is prevalent in the market, where there are supply issues, I think they will crank up their utilizations. So I think they could put in about 800 crores of more of revenue. And next year, when they do another 1,200 crores of capex, another 600-700 could come in, because you start ramping up slightly better because the opportunity is there. So I think with very high margins, margins could explode. Also on the higher side, but you're at 40%. Okay, and I think Vinati Organics is a better stock right now than Divi's, considering that.
Okay, so that's the view that's coming in on Divi's. Foram, what's your view on Divi's lab? Do you all have active coverage on it, and are you recommending it to clients?
So we do not have active coverage on the stock, but then if we look at the company, we feel that the rally would continue, because the largest product what Divi's make is into APIs. And if we see the API business, the API supply in China, they are facing supply constraints over there. So this one would get a direct benefit out of that. So that is one of the moat, I would say, which Divi's is enjoying currently. Of course, it has come back on the track with regards to margins and everything, and it is one of the pharma company which does not have much of US FDA problems also. But having said that, of course, it has a very high valuations, compared to the stock that I've been always recommending, Jubilant Life Science. So we feel that the rally would continue, but if I have to pick, Divi's over something else, I would go for Jubilant Life Science rather than Divi's.
What makes Jubilant Life special? What do you like in it?
Yeah, so now if you see, even it has reported Q3 numbers, and it's come very nice. It's one of the consistent performer in terms of bottom line. The growth, if you see, it's growing at good 20% and upside. Plus, if you look at the life science business that Jubilant Life Science has, that is also like, I think 50% of the total revenue, and that is also growing at a very good pace. Plus, financials are clean for Jubilant Life Science. Again, does not undergo much of US FDA problems. So Jubilant Life Science, having said that, trading at what, 9 times FY20 PE, it's very attractive. So we recommend Jubilant Life Science over Divi's.
Okay, and what about you, Samir? What's your view on Divi's lab?
So I think the rally might continue. As Vinit said, it might get slower. There are two factors to it. One is the two base which are left. 2 quarters which are left are low base. So YOY performance will be better off. It's now more when your high valuation kicks in, it's more of quarter on quarter performances, how you're able to perform. And secondly, if you see the balance sheet in September, the receivable days and inventories are stretching now. So that means you're able to push out your P&L and that's much more smoother. But the balance sheet somewhere is getting the pressure out of that sales. So I think that is a concern for me. And if you already have, keep it with you for a couple of quarters maybe. But I don't think so there's a place to enter right now.
Okay, so that's the view that we're getting in on Divi's lab. At least the consensus view is that probably the rally will continue. But if had to choose, the other stocks would be selected. Vinit Organics, which has been again a marked outperformer, is something that Vinit talks about. Foram talks about Jubilant Life. But if you hold Divi's, you can hold it, but not a fresh entry at this point of time, is something that Samir talks about. The other pack which has actually started moving higher over the past few days are the two-wheeler stocks. So autos has been a marked underperformer. Most of the auto counters have corrected significantly, 20-30% from the highs, given the fact that the auto sales numbers have not come out. Now, a couple of triggers that came out was firstly the budget, in which there was a lot of emphasis on rural, and secondly the auto sales numbers for the month of Jan do not point to a very bleak picture at this point of time. So in the auto, we'll stick to the two-wheelers. Forum, are you recommending your clients to accumulate two-wheelers since they've corrected so much?
Yes, so we are advising our clients to go for Bajaj Auto. Well, having said that, Bajaj Auto and Hero Motor both are at par in terms of valuations. But if we look at the monthly sales numbers, Bajaj Auto has continuously been reporting very good set of numbers. The export numbers also, for Bajaj Auto continues to do good over a span of like more than 6 months now. So, Bajaj as a overall in terms of export, domestic, both is doing very good. But if we see Hero Motor, I think it has reported a degrowth for this, for the last month. So, we are a little skewed towards Bajaj Auto than, Hero Motor Corp. We would want to completely avoid TVS Motors for the fact that it has, huge, high valuations. And as you rightly mentioned, the interim budget rightly points out at the relief for the rural people and the middle class. So, two-wheelers, there was a lack of demand in the two-wheeler space, in the auto space. I think that gets, nullified, and we would definitely see a demand pickup, especially in the two-wheeler side, and supported by good export growth for Bajaj Auto. So Bajaj Auto remains the top pick out of the two-wheelers.
What about Eicher? Is that something that you're telling your clients to buy?
At the moment, no, because we would want to see how the premium segment, in the two-wheeler space pans out to be. This is like a premium, entry-level two-wheeler for Bajaj Auto, and this kind of, relief package what government has declared for the middle class and the rural people. So the first demand would come into the entry-level, two-wheelers rather than the premium segment, and that is why we first want to go for Bajaj over Eicher.
Okay, what about you, Vinit? What's your view on two-wheelers? Have you all told your clients to start accumulating or avoid that?
I think that market is very crowded.
Okay.
And everyone is fighting to gain growth. So, Bajaj has been all over the place. They were premium bikes, they were doing very well there, but competition has caught up. So having no room for growth, they've now decided to throw caution to the wind. And when they were focusing on ROEs earlier, they have now dropped prices and enter the entry segment. So because of the entry into entry segment and the discounts that they've given, they have been able to grow last quarter at 33%. This month they grew at 22%. Okay, and because of that, the big loser is going to be Hero Honda. Okay, because Hero does not do anything beyond 110, 125 cc. They don't have any presence. Okay, so that is a problem area out there. Bajaj needs market share. They're going to see, because they need market share, they're going to go very aggressive on pricing, and then you have negative EBITDA growth. Okay, and although they show 16% PAT growth, that is coming purely from your other income, So, looking on these stocks on a PE basis doesn't look right. If you go and do it on a EV by EBITDA basis, what you're getting is that Hero Honda is at 9 times, Bajaj Auto is at 11 times. And with, I'm seeing slowdown coming in further, and the market is going to get increasingly crowded. So we think that TVS might be a better play compared to the other two, but TVS valuations are expensive and their growth has also become negative because of Bajaj dropping prices across the segment. So it's a mess, and I believe that the sector will underperform. Okay, so to my mind, it's more of a avoid kind of situation until the
you
crowd
think
clears
that
up.
for a while Bajaj has always been maintaining that they have the highest margins in excess of 20%. Now that they're going in for market share and margins have fallen to 15%, do you think they've gotten the strategy? Is this strategy right, or they've gotten the strategy wrong?
No, see, there are two ways to grow. So I want to maximize my money, right? So when I'm facing headwinds and I'm not getting volume growth in one area, what do? So I will go for higher growth in EBITDA. So for that I need to get into a segment where I can dominate. If you take all the segments wherever they are, Bajaj is losing share. Okay, they're dominant in certain segments, but the segment which is up for grabs is the executive segment. So their Hero Honda has a 67% kind of market share, and no other player has done any bit out there. So Bajaj, because they have got the balance sheet strength, they see that they can go and claim a large pie out there. The other segment, the mid segment is very crowded. In the higher segment, Bajaj is going to come in with Triumph, and they're going to come in with the other products. So there they feel they're pretty confident out there. So now they're trying to grow through the entry segment. But when you are getting into the entry segment, you have to dislodge the largest player in the market, and you're going to push your prices lower, and that segment is not growing. Okay, so till FY20 we are going to have all these kind of issues. BS6 norms are going to make bikes more expensive, so the entry segment will become even more expensive, and then in FY20 onwards, you are going to see electric vehicles come in. And if you go and check each and every industry globally, the new leader is an unknown. So Netflix hit media, Amazon hit retailing. So you don't know who's going to come and hit here.
Okay.
So I believe that this sector, which is going to underperform, where each one is trying to benefit themselves the most and margins are getting to be pedestrian, I think it's a clear avoid.
Okay, before I move to Samir, you think the points he made are valid because you said Bajaj, and he's certainly claiming that there will be pressure because he's going on undercutting margins and all. So is that a valid strategy that he's doing, or will that make this segment even messier?
I think it's a valid strategy what the company is adopting, because as you rightly mentioned, it has good margin, it had a good margin room upside, and he's taking a price cut because he can afford to take it. Despite that, I think the margins is going to be in line with the industry margins. Having said that, the market share, I think, of Bajaj is 20%, and the company wants to grow from 20% to 24%, and that is why it is taking a hit in the prices. Now I think it is just like a wait and watch approach, because the macro scenario looks favorable right now for the two-wheeler industries, and if it's executed well, we feel that two-wheelers among the entire among the entire automobile space, will be the first one to perform. So I think I'm very bullish on two-wheelers.
Okay, Samir, what's your call on two-wheelers? What's the pecking order and what's your view?
So I prefer Bajaj, but on the whole industry, I have a negative view as of now. Okay. Because the registrations are 6 to 7% down even on the Jan month. So that means inventory is still there in the system, which is not liquidating. That has two reasons. One is on the two-wheeler side, ABS norms kick in April. And if you see, Honda has only 20 to 30% models which are ABS norm compliant. Bajaj has around 70 to 75% now, and Hero is running on 60 to 70%. So Honda will be the most suffering segment company over there, which will create a space in the mid segment, which I think Bajaj will be able to take over into that. Bajaj is fighting for the lower segment, and I think over there that's a better strategy for at least a while now. And we are a buyer over there, but we are in tranches. We are not buying at a random pace. And if it comes from a 20% EBITDA and gives me a more market share in the segment, I think it's a high time Bajaj took that call and made it over there.
Okay, so that's the view that's coming in.
So I would like to add one more thing out here. Bajaj used to sell about 40,000 three-wheelers. That number went to 72,000 last year. And that is also now coming down. So it is at 57,000 now. So I think it will settle around a 55,000 kind of run rate.
Okay.
And I don't see Bajaj now going in for price gains because even in the mid segment, the competition is going to heat up.
Okay.
So I think the entire segment is a avoid.
Okay, that's the view that's coming in on the two-wheeler space. I think Bajaj features the top pick among two of our guests at this point of time. But overall, I think Samir and Vinit believe that the space is overcrowded. Forum likes Hero and Bajaj at this point of time. Let's move on. And if you see the Nifty, it's very interesting. While the mid-caps and small-cap have gone to the cleaners, the Nifty's managed to hold on. And that's only on account of four stocks. There is Infosys, there is TCS, there is Reliance, and there is Axis Bank. So these four stocks are the only ones that are keeping the Nifty afloat. So we've taken 3 out of them because Infosys probably what we've spoken remains most of the people's favorite picks. So we've taken Reliance, Axis and TCS. So what's the pecking order on the Nifty? What's the view on these stocks? That's something that we'll ask. What's the pecking order in the 3 large caps?
So for me, TCS, Reliance and Axis.
Why?
TCS has been always one of our favorites because the cash outflow the investors receive, and it has been a consistent performer over there. And IT is where we believe is now growing on a smaller growth, but the digital revenue and the margins are much higher. So maybe in next 2 years the margins will look much better than what people expect right now. Reliance, the cash flows due to the reduction in capex this year is coming out better. That is getting deployed in the fiber and other capexes, which I think if you're able to create a new market as in a whole, and especially when the media houses are facing these issues, I think Reliance is one place which is diversifying into retail and the telecom space. The Axis we like because of the new management who's coming. The numbers have been settled, but we'll still hold on to next 6 months and see how it goes. And the hiring they have done from Mr. Maheshwari from HDFC Bank. He's come from Federal, but he has an experience of HDFC Bank credit officer. So I think that's a very big positive for us too.
Okay, Forum, among the 3, which is the top pick that you have among the 3 large caps?
Yeah, so the pecking order would be first Axis Bank, TCS and Reliance. Axis Bank, as we know, that has just come out, from the mess, and we feel there's a long way to go, given the fact that the new management is going to execute, very well, and that is why we are projecting, that the NPA mess is going to be definitely cleared, and it's trading at very good attractive valuations also, compared to the private banks, which are like, highly valued. So we feel that Axis Bank still has a long way to go among the entire stocks that we have for pecking order. Second would be TCS, of course, because it's delivering very good set of numbers. The digital revenue space, I think, is growing at 50% and it's highest in the industry with regards to even Infosys and other IT companies. And as the management has rightly guided that even on a higher base, the digital revenues is going to keep on increasing, which is very good. I think earlier BFSI as a segment had a problem, but now even that is getting resolved, and that is also doing very good. So TCS, though after reporting the 3Q numbers, has rallied almost like 10%, but we still feel that it can rally more 5%, going from here on. So TCS would be the second pick, and third would be Reliance, because Reliance throughout has been rallying quite a lot. And if you look at the petchem business, that has done good, but I don't think so margins have come, margins are flat in the petchem business. Oil and gas segment is not doing that good. The only profit that we are able to see coming out from Reliance is basically because other segments like Jio and the retail business is aiding to the profits. So that is why Reliance would be the third pick.
Okay, what about you, Vinit? What's the pick?
So my pecking order is Axis, Reliance and TCS. Axis purely because we have seen the first signs of normalization of business. So the NIMs have come back to 3.5. Okay, so what that really means is that the recognition from the right backs is come about. That is number one. Second is, their watch book is still falling off. So the stressed assets, although they're coming off, the NPAs are little bit on the higher side still. So that is one little area that we want to watch. But if you're expecting ROE to climb back to 15% over the next 2 years, and your price to book is about 2.2 times, I think for the franchise that it has got 46% CASA. You know, they're a good corporate plus retail play. I think compared to the other banks like HDFC and all, here there is a lot of recovery in place, plus there's a new management here and with a lot of efficiencies within the system itself.
Okay.
So all that will kind of, you know, play out over the next 2 years. So we believe you get the maximum bang for the buck out here.
Okay.
So you could see about 50% appreciation over the next 18 months.
Okay.
Is what I'm looking at. I think Reliance, now the play will come in from value unlocking. So you will see the company want to deleverage. So, you know, you go to an asset light model, your infrastructure in terms of fiber and all could go out, you know, you could get in money. So there are a lot of things that work. And now you become one of the dominant players and you have got the entire ecosystem in place. So you talk content, you talk fiber and you talk market share in terms of subscribers. So I think new levers on a new business will keep growing and you're at 12, 13 times ROE. If you become asset light, that will go up. So what will impact is that your multiple, which is lower to the index, can go a premium to the index. Okay. And TCS is a known story. Okay, but it is a tad expensive. It's 20 times FY21.
Okay.
All things remain good. So given the growth potential of the three stocks, I think that would be my pecking order.
Okay, so that's the view that's coming in on the pecking order, and finally we are almost run out of time, so this has to be very quick. One stock that you believe can outperform?
We still maintain Petronet LNG.
Okay.
I think there's a good chance to make 50% money with very, very low risk. And typically the stock is traded at 20 times. So there's a possibility that, you know, over the next 2 years you could double your money.
Okay, Petronet, just a follow-up question. You are quite bullish on Sterlite Tech with what's happened. Are you still holding that positive view?
Yes, we are holding a positive view because of 5G and all that is there. The only concern is that, you know, the pledge is too high.
Okay.
So while the franchise remains consistent and all things are going well and they're getting into virtualization of your hardware, there's a huge pie that opens up. The only concern is what the management will do with the pledge shares.
Okay. What about you, Samir? I'll come to you. What's the
So
stock?
for us, 2019 we think is a good year to get into Oberoi reality.
Okay.
We believe the completions of the three main projects in Borivali and Mulund are coming up. So if they go 55-60% from right now, they'll create a good amount of cash flow for them, and the rental income has stabilized around 350 crores, 400 annually. So I think over there Oberoi is our pick.
Okay, and Foram, which is the stock that you all are telling your clients?
So we are recommending HUL, and we have seen it's delivered very good set of numbers. Even the budget, you know, as we said earlier, has given immense positive, you know, for the consumption team, and the fact that there's going to be a direct transfer of money, you know, via pension on hand and everything. The first thing they're going to go and buy, rural people, is going to buy, you know, they're going to buy necessity items, and of course, we know that HUL has a rich product portfolio and the, you know, steps that it's taking, like for example, acquiring a Horlicks brand and all, you know, it's going to give them good synergies by getting them good, new geographies and everything. So we feel that even on a higher base, of course, you know, HUL will be able to deliver a good set of volume growth, and of course we know that the return ratios are very favorable, good management, good financials. Of course valuations are higher, but then I think everything is justifying the premium valuations, the demand, the financial ratios, everything. That is why we feel that HUL can go till, you know, 2100, and that is why we recommend strong buy on HUL.
Okay, so those are the stocks that are being recommended: Petronet LNG, HUL, as well as Oberoi Realty. Those are the three stocks that we spoke about as far, but we had to cut it short because we are completely timed out. With that, it's a wrap on today's edition of Hot Money. Many thanks to all my guests, Vinit, Foram, Samir. Thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg Quint.